From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, it's Friday, August 2nd, 2019, and this is the Hamilton Place Strategies Macrocast. I'm Tony Fratto in New York. My partner, Matt McDonald from HPS, is in the studio, along with John Fagan from Markets Policy Partners. Our usual companion, Brendan Walsh, is on the road this morning. Okay, gentlemen, happy Jobs Day.
Happy Jobs Day. I like being the sixth man on the podcast. I feel like I can save up all my pearls of wisdom.
It wouldn't be a Jobs Day without you in the studio with us, though, Matt. We need you there.
Yeah, thank you.
When last week on the Macrocast, we knew that we would be talking about non-farm payrolls today, and we knew that we would be talking about the FOMC decision earlier this week. We didn't know we'd be talking about another escalation in the trade war, and so we're going to end up getting to that and spend some time on that today. But let's start with the jobs report. It was just out a little while ago. Matt, I know you've got the numbers. Jobs.
It's another solid report. The total non-farm payroll rose by 164,000 in July. Unemployment rate held steady at 3.7, which is still a big low. Some other tidbits in there. The labor force participation rate was 63%, which is something that we're keeping an eye on as the cycle continues. There were some downward revisions in a few of the last couple months. I think May and June ended up 40,000 or so less than what the original report was, which wasn't great, but you still have kind of a rolling average of around 140,000 a month over the past stretch. And when you think about the jobs numbers, my recollection is that it's about 110,000 a month just to kind of keep pace with population growth. So at this stage in the cycle, with unemployment at a historic low, anything north of that is it's positive. And then the other piece that's a couple of other pieces that are important is wage pressure continues. So on kind of a rolling 12-month average hourly earnings are up 3.2%. So that's good, and at this point in the cycle, that's part of what we want to see in strong jobs reports. The one thing that some people took note of that was not as good as the rest is work week hours were down just a hair, which not a huge deal, but just notable at this point, and
especially in any given month. I mean, you can see
the some of the discussion too, which segues into some of our other topics, is that the manufacturing numbers were not great. Not negative, but it's just the manufacturing sector as a whole in the jobs recovery is not leading the charge.
And that's a global phenomenon. Obviously, thanks, Matt. We've seen so many of the ISM and PMIs, purchasing manager indexes, which are the manufacturing sector and the services sector. The services sector looks pretty good globally, right, and manufacturing looks awful.
Right.
And the U.S. came out with its numbers. The ISM is the U.S. version of the purchasing managers index in the U.S. We also have a PMI, but the ISM is the one that's more closely followed, and that was a little bit on the soft side. But the rest of the economy appears certainly to be ticking along nicely. We saw that second quarter GDP upside surprise with very strong consumption numbers. And there was a non-farm payroll. When you get a big, robust number like this, there was a sense that this could have been a very market-moving number. If we'd had the Fed, we'll talk a little bit more about the Fed, but there was a rate cut for the first time since 2008 on Wednesday, but with non-committal signaling for future cuts, which is not what the market expected. There was a reaction as though Fed Chair Powell was maybe more hawkish than traders had assumed he would be. And there was a sense that markets were bracing for what could happen if a really solid non-farm payroll number came in and sort of basically fueled those trends. And those trends were, which we saw after the Fed, were stronger dollar, a sell-off in the 2-year policy-sensitive front-end treasuries. That's the 2-year particularly, and those yields going up as expectations for Fed easing were peeled back for the future months. Now, there were intervening factors that dulled this this potential effect.
This week feels like the summer economic cliffhanger to whatever's going to happen in the fall.
Well, he said and the president sort of set up the cliffhanger a little bit with with tariffs set to go into effect in September. So we'll have a little Labor Day weekend surprise to see how that goes. But can we just
for both trade and the Fed? I mean,
it all blends together. In fact, we're going to have a hard time keeping this podcast in sort of clean segments because they do all blend together. But I do want to dive back into the jobs report for a little bit before we do talk about those other two pieces. And it's on. So Matt, you mentioned wages. One of the things that I saw, and I don't know if you saw any of this, but and I wish I could remember who the excellent reporter was who sent it around, but showing the wage growth relative to income, so that the largest percentage increases in wage growth are actually at the bottom. So like low wage earners are showing, which I mean
that is correct.
You would expect that, but it's really great, right?
Yes.
I mean we want to see, it's over 4.6%. I think was the number I saw. Really strong year-on-year wage growth for low-income earners, strong for middle-income earners, and still growing for high-income earners too, just not nowhere near the same rate as low-income earners. And that's if you're looking for a positive on wage growth, that's where you want to see more wage growth.
That's correct, and this is the part of the recovery where the incremental worker that in the past a prospective employer looking to hire someone, maybe this was the person who is fifth on their list, and now this is the person who is number one on their list. So you're just at that part of the recovery where the lower end of the workforce is benefiting a ton. They're going to be the ones getting jobs. They're going to be the ones, all else equal, who are seeing the wage growth. It's really good. Powell has actually talked about this aspect of where we are in the recovery, and it's part of the reason I think that there's been so much focus on all sides of policymaking in DC on extending this as far as we can, just because there is still that element of the crisis overhang where it feels like having a nice long recovery where that part of the economy can benefit is really important for a host of reasons beyond even the economics.
That's a great point. And one of the other things that Fed Chair Powell has said is that the traditionally understood linkage between rising wages and inflation is not nearly as strong as it used to be in his view, and that appears to be the mainstream view of the Fed. Not everybody, there are diversity of opinions on the board, it seems, but that is certainly where most of the Fed seems to be at this point. And the understanding that you can have wages rising to the upside and not translate that through into consumer price increases and keeping inflation rates and price pressures generally low, that's a very attractive, not just economically attractive formulation, but it's what traders on Wall Street called Goldilocks, which is the you can have not too hot, not too cold. You get a relatively strong and improving economy, but without those overheating aspects that come through the wage price spiral, which appears to be, who knows for what reason. People have a lot of ideas, demographics, Amazon, whatever it is, but we don't see any evidence of it right now.
Yeah. There's another aspect of this side of the economic cycle that's important, I think, in a tight labor market and what that looks like. And I can remember in the 90s, during that robust labor market, there was also a lot of job switching, and workers took advantage of the tight labor market to make a change, do things that they wanted to do, progress within their field, what have you. in that context, it wasn't that the cycle was so long; it was just that it was really hot. But I would expect that to be a dynamic in the current cycle too. Is that if you're trying to adjust where you are. I mean, you think back to early in this recovery where it's post-crisis and people were more concerned about keeping their job than they were about progressing or trying something new or whatever. It's that part of the cycle that's really good for workers on a bunch of different dimensions, either coming off the sidelines or making a change. And that's also really good for the economy as a whole in terms of reallocation of labor to more productive uses or to things that people want to be in. Those are all really good aspects of where we are in the cycle.
Hey, can I ask about one more thing I noticed? I mean, in the jobs report is John, you mentioned the manufacturing, or maybe it was Matt who mentioned manufacturing jobs slow, but it seems like there's something. There's some things in there that are structural, and structural, I think, is to me what's going on in retail. Retail jobs have been down. That's a trend. They're going to be down. It looks like there are things happening in that sector. How much of the manufacturing jobs were energy related? Is it it seems to be a correlation with a lot of oil energy jobs that I don't know if you had a chance to take a look at that.
I don't have that data at hand. Matt is.
I'm flipping through
flipping through the.
Unfortunately, this is not properly understood as a cheat sheet. What I'm looking at. This is the long version.
Yes.
So I did, Tony. Yeah, I did see. I did see people talking about energy in particular, but I don't particularly remember whether that was a driver.
We'll take a look at it. But
it's interesting that you mentioned that, Tony.
we,
there is some discussion about the energy patch right now, the shale patch, obviously doing well with steady oil prices, but oil prices have had a pretty big impact with the trade stuff, bigger than equity. So we can talk about that in a bit.
We'll take a look at it, and we'll come back. When we come back next week. Maybe we take a look just at the manufacturing.
I'll probably just interrupt awkwardly in like 5 minutes when we're on to another topic.
Feel free. feel free. But the thing is, we talk about manufacturing jobs, and people imagine that it's that we're talking about just hard hats on factory shop floors. And there are, and we should always remember that there is this volatile sector of the economy, which is energy, and sometimes those jobs can move around.
I loved we had HPS had Neil Irwin in to talk to our staff a little while ago about his new book, and one of his great anecdotes was that when he started in the newspaper business back at the turn of the century is that he was actually classified as a manufacturing job because he was part of the process of manufacturing newspapers, which
is true.
Sometimes data doesn't tell the full story.
Let's take a break. When we come back, I want to talk about that known that we were going to talk about this week, which is the Fed, and it was a rocky announcement, a rocky press conference, and aftermath for Chairman Powell. But let's dive into that. You're listening to the Macrocast. We'll be right back.
The first Friday of every month is Jobs Day, when the latest jobs and labor market data are released. HPS makes sense of the numbers in our Jobs Day report. Sign up online at hamiltonplaystrategies.com or follow us on Twitter to learn more.
Okay, we're back. Tony Fratto and Matt McDonald, Hamilton Place Strategies. John Fagan from Markets Policy Partners. It's the Macrocast. So, I mean, we've been pointing to this week for Chairman Powell for a while, targeted as the month when we are going to see the cut in the FOMC was going to cut rates. They did by a quarter point. There was some speculation that they might go 50. But the messaging around it was, I think, a little bit messy and left people scratching their heads. Do we have a sense on how the FOMC really thinks about this economy right now?
There was definitely more there was more detail that market participants had either missed or not heard or had not been communicated clearly on the Fed's thinking during Wednesday's the communications that accompanied Wednesday's decision. So as you said, the Fed cut for the first time since 2008. It was in line with consensus, 25 basis points. The voluble communications leading up into the meeting had finally, after lots of variation and gyrating back and forth, finally cemented consensus at 25 basis points. And everybody felt like, Wall Street felt like they had a pretty good read on where the Fed was.
And yet,
it
seemed like there were people who seemed to be expecting 50 basis points or more forward guidance, right?
That's right. I think there were opportunities for Fed Chair Powell in his Humphrey Hawkins testimony, which came right after the June solid June non-farm payrolls number
to dial it back.
To dial it back. The futures markets had already done a lot of the work for him. He could have said, that was a pretty good number. We are still biased toward accommodation, but, we're obviously taking things as they come and we're watching the data and so on and so forth. And he basically went out of his way to downplay the strength of the labor market, saying the, wages and strong labor markets and tight labor markets aren't leading to inflation. We're really worried about inflation. We're really, really, really worried about low inflation. We've got to get ahead of this. And that was the proactive message was hammered home by Williams and Clarida just before the blackout period, when they made their appearances and talked about being trying to be as proactive when you see trouble on the horizon. Markets after those appearances put odds of a 50 basis point kind of shock and awe start of the rate cut cycle at like above 60%. Right. The Fed walked those back, but clearly there was a sense that in the markets, and that you just simply couldn't misread. If you were watching it, you simply couldn't misread the message from the futures markets, which is we're not expecting an insurance cut. We are expecting a campaign of monetary accommodation. We've had, it was basically the base case coming into the meeting was 3 rate cuts cumulative to year end, plus some priced in for 2020. And Fed Chair Powell clarified that this was not in line with the Fed's thinking. There was, first of all, the rate cut had 2 dissents. Boston Fed President Rosengren and Kansas City Fed President George both dissented. 2 dissents is kind of a big deal these days on the Fed. Usually you might see 1, but 2 is pretty big. And the accompanying policy statement definitely sounded more balanced on the economic risks than some of the Fed messaging coming into the meeting. And then Fed Chair Powell, in his post-decision press conference, was quite unambiguous. He characterized the rate cut as a mid-cycle policy adjustment. Yeah, and talked about a bit of insurance, and indicated in no uncertain terms that this was not the beginning of a long series of rate cuts. He wavered a little bit and said he didn't say it's just one and done, but the markets were left, flummoxed again.
The thing about this couple of weeks is that it doesn't feel like, from Humphrey Hawkins to the announcement this week, it doesn't feel like intentional recalibration. It doesn't feel like perceptions of the market within the Fed were fundamentally changed. It just feels like they're not doing a great job articulating to people like where they're really at on this stuff. And there's some aspect of some of the times with this, you want ambiguity, you want the market not really quite sure what you're thinking. But this has the quality of like the markets don't really know what they're thinking because they're saying multiple things.
You also get the sense that people would watch Janet Yellen's press conferences and and they were pretty boring because her answers to questions were almost word for word repetitive of what was in the statement or was clearly on her talking points in front of her, but that was the least disciplined and consistent. And I will say that Chairman Powell's press conferences are a lot more interesting and fun, but you don't know what you're going to get necessarily. You don't know whether he's going to be able to stick to the clear messaging that they've worked on, obviously leading up to the meetings, and he tends to wing it a little bit, and he kind of says things that he doesn't. It's not clear that he means when he's signaling what he thinks is coming forward.
Right, and when the dust settles, the futures markets, obviously the chairman's words have a lot of impact, but the credibility seems to be a little bit skewed when Fed Chair Powell sounds dovish and is inclined toward easing. The market really puts a lot of stock in that, and they tend to take an inch if he gives them a mile on the dovish side. But these days, when he has a little bit of a more balanced, and we've seen this a couple of different times over the past few months, when he has a more balanced formulation, the market gives him maybe a little less credit. And so the Fed, obviously, the communications were quite non-committal on the pace of future rate cuts, and the sense that September might be a time for them to sit and wait and watch. September rate cut odds never went below 60% in the futures markets, and they settled around 65%. So there was a sense that the markets are fighting the Fed a little bit on when the Fed says we're thinking of pausing, the market says I don't know if I believe you. So
whether they believe him, yeah.
And then of course all this sort of became an academic discussion after we saw after yesterday's events. So.
Yeah, one of the questions on this, one thing Chairman Powell was very, very clear about was that one of the factors influencing his and the committee's decision to make the move on the quarter point cut was the uncertainty that's being created by the trade war tension, slowdown in global trade that is resulting from that. And you have to wonder whether resting the FOMC's decision on the quarter point cut on uncertainty in the trade war wasn't an invitation to President Trump to go out yesterday and do what he did, which is to announce, surprising everybody, with his intention to pose 10% cuts on $300 billion of Chinese goods. The paperwork on that should be going forward today, and we just saw the response from the Chinese, which are they're going to take countermeasures. They don't see this as productive or conducive to continued negotiations. So more uncertainty now in the trade war. What does the FOMC do now? And I would expect that we would be looking at another quarter point cut in September now.
That's so much of the commentary that we got from our Wall Street contacts right after the Trump tariff announcement yesterday was, wow, President Trump really wants his rate cuts. That is an example of the Fed-centric thinking that really prevails on Wall Street these days. And the futures implied odds of a September rate cut are 95% right now. The cumulative rate cut expectations to year end are 70. That's including earlier this week. Are up to 75 basis points. There's another one in 2020 priced in with a hint of another one after that. The futures markets have lurched back to pricing in a very steady easing campaign.
So here's my question for the markets though. So they're putting the odds on the Fed response to Trump. What do they think the odds are that the announced Trump tariffs for September actually go into effect?
Yeah, I think that's the sort of magic we saw some downside in risk assets yesterday. The S&P was up about 1%. It reversed that and closed down about 1%. That's a pretty big swing. Stocks are down again today about 0.5%. But we're only 2.5. We're only 3% off last Friday's all-time highs. So it's not as though we're in full flight into cash risk aversion mode. This is a pretty gentle sell-off in the grand scheme of things. And I think you speak to it, that speaks to exactly what you say, which is it's given what we've seen in the past, it's very difficult for investors and really anybody to take these kind of tariff threats at face value. Some of them do end up coming into being enacted, but plenty of them have not. And we saw a headline from CNN not long after the non-farm payroll number from sourcing an unnamed administration official saying that the Trump administration, that President Trump was open to delaying or even canceling the 10% tariffs on this. On the $300 billion that he threatened.
Say, John, I don't know I don't know. They've been an unnamed. I've been an unnamed administration source myself. You tend to say things to put, more clarity on something, but it sounds to me like that's not bringing more clarity. It's bringing, the president was on the North Lawn yesterday saying, you know what, we could do these in phases. They could go up. They could also go down. We could talk.
I don't think clarity is his goal.
There was no clarity. Yeah, I don't think that like saying that they could not go into effect that brings any more clarity. I think it just brings even less clarity. And it's
I don't know that there could be less clarity. I think that they're pretty not clear.
I think they're not clear on signaling intentions, but I think the trend is certainly clear. The president likes tariffs. Correct. He wants tariffs. He thinks that's the leverage to get the Chinese to do certain things. The Chinese are, I think, a more grown-up country than we give them credit for, and they want some things in return, and this is an administration who's willing to give them things in return right now. So I think we're in this situation. I think we're going to be in it for a while.
That's totally fair, Tony, but I always think of myself, flashback to an investment committee meeting talking about equities, and you say, all right, is this really it? Is this when do we have to really bring down risk in the equity portfolio and the whole portfolio to account for this new round of tariffs that's being threatened? And you look back in the past, and some of those tariffs have really come into effect, and some of them have not. It's a little hard to, against the Chinese, certainly there are plenty of tariffs already in place. But if you had sold off all of or taken risk way down and sat in sidelines in cash at these various points, you would be way behind. The market, the equity market, U.S. equity markets keep chugging higher, and so there's a sense that you can that incentivizes equity investors to that selective hearing, which is the bad news. The reaction to bad news is maybe less acute than the reaction to a hint of good news. So when they hear, an unnamed official saying something positive, the upside pop. I mean, futures went green this morning on the back of that, and they were down pretty huge.
I saw somewhere. I saw a spicy take that that this announcement by Trump is like the Mexican tariffs, that it's like the signal the 1-day strike before a union agreement to show that you pushed it all the way to the limit. And it was this take that, this probably means that there's progress and that there's going to be a deal, and people just reading into it what they want.
Yeah, everybody's reaching for their well thumbed through copy of the Art of the Deal. All right, what page is this one on? Okay, all right, let's.
Are we? I mean, from a macro standpoint, do we spend too much time, talking about trade? I mean, obviously, conflict is great to talk about, and there is something real going on in trade, and trade flows are down, and there are lots of implications for it, economic and political. But as a share of GDP, it's not that large. We still have an enormous domestic economy that's doing really well.
I do think that I will say that this round, that on balance is aimed more on consumer goods side, is interesting in different ways than some of the past rounds have been, just in terms of the way that consumers may feel it. The retail sector that we alluded to briefly during our jobs conversation, that is under a lot of different pressures, and this would add to that. This round does have a feeling of, less in the policy realm and more in the brass tacks of the economy. And going into an election year, it feels like it'll just have a lot of implications, and one to kind of keep an eye on as something more than just kind of a chess piece in, geopolitical strategy, trade stuff.
Yeah, certainly reading the markets, even though I talked a lot about the equity reaction, the big move was really in treasuries, and we had an enormous rally when President Trump announced the new round of tariff threats, we had the 10-year yield drop 11 basis points. That's a huge move for 10-year Treasuries, dropping not just 11 basis points, but 11 basis points that took it below the pivotal 2% level, which it had been held up above, for a long period of time. It's now decisively below that. 10-year yields are trading at around 1.85% today. That's and had continued lower overnight. These are levels not consistent with a positive growth outlook. Certainly some of this is expectations of rate cuts coming back into the picture, and we saw that weighing. But that's more about the front end 2-year and shorter duration yields. The back end 10-year and beyond is much more driven by expectations about growth and inflation. And 1.85% isn't telling you that expectations aren't consistent levels with a big pickup or good economic outcomes. We saw oil prices, which are very sensitive to demand these days. Oil prices were down huge 6% yesterday. People were focused on the composition also of the equity sell-off. You got a lot more in retail, as you said, Matt. This is potentially much more impactful of the retail space than previous rounds of tariffs. We got cyclicals and growth-sensitive stocks taking it on the chin, and so investors, because interest rates are so low, that tends to be generally supportive of stocks, what they call the TINA trade. There is no alternative. If you can only make 1.85% on 10 years, former Fed Chair Bernanke called it the portfolio rebalancing effect. Basically, it's chasing my parents out of bonds where they want to be into equities. And so you look at what performed well yesterday: healthcare stocks, utilities, stuff that is insulated. But people need to be in equities structurally.
There's another piece of the trade dynamic that's worth mentioning and reflecting on. There's a few. It's interesting, over the course of the week here at HPS, there's been a few threads down this road. We had a intern panel earlier this week, people talking about DC and one of the lobbyists who was here was saying, members make their decisions based on what constituents tell them. That's what's driving this stuff. And then there was another, Rich Tao was in talking about focus groups he's done on swing voters, and he played some videos for us, and they are in favor of tariffs. The swing voter is behind Trump on this stuff. And then you had the doubleheader Democratic debate, and they're not rushing.
They're not even talking about it.
They're not rushing to get back in the free trade game. So from a macro perspective, there is a little bit of, maybe this is just the new normal, and firms need to be looking at supply chains, and the markets need to be not looking at an excuse for why things will get better on the trade front around every corner. I mean, that may be structurally where both the politics and the economics of it are.
And I think that segues into a very good point. We just saw a really solid second quarter earnings season. It's not done yet, but corporate reporting for the second quarter has been really pretty upbeat. And there's definitely a skew in performance, domestically focused, the more domestic U.S. The larger percentage of your revenues are for domestic U.S. sources, the better you tended to have done in this quarter. But that's not universal, and corporate management is dealing with this. And there are plenty of stocks that where management has come out and said, we've got a lot of challenges in our overseas business because of the tariffs, because of the trade stuff. There's reshoring, shifting supply lines, the flexibility and the ability to deal with these logistical issues. It's translating into, it may be a drag, but it hasn't turned into a wholesale disaster for earnings, certainly not this quarter. Maybe it's a cumulative effect. Maybe it builds in intensity, and maybe the additional round.
Wait. Before we go to break.
Okay.
You're right, Tony. The energy jobs were down. Though I will say construction was worse.
Oh, was it really?
Yeah.
That's interesting. Well, maybe we'll find some time to resolve that in the ensuing weeks, because of where housing and other things are right now too. It's interesting to figure out. Let's take a quick break, and John, we get back. just give us, what we need to be paying attention to next week, and then we will call it a wrap. This is the Macrocast.
You're listening to the HPS Macrocast. Every Friday, we take a look at the major economic trends of the week. See more from Hamilton Place Strategies at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, we're back on the Macrocast. John Fagan, Markets Policy Partners. What do we have to look at next week?
Next week is a mercifully relaxing calendar, actually. It's pretty sparse after some...
We had a pretty heavy week this week. We have a nice long podcast this week, but there was a lot of news. But light next week.
Absolutely, we're going to be getting it. We've gotten the manufacturing purchasing managers indexes in already for July. Now we're getting next week come the service sector PMIs. Those have indicated generally more upbeat levels in just across the globe, not just in the U.S., but we're getting the U.S. one and global as well. We've got a couple of other central bank decisions. The Fed has done their bit, but the Reserve Bank of Australia is coming in next week, and they are in cutting mode. So that speaks to the situation in which the Fed has been in a progressively easier and easier mode, broadly speaking, since the beginning of the year. And that has brought Treasury yields way down. But it hasn't really done anything for the dollar. The dollar is up toward the top of its recent trading range. And part of the reason is because the rest of the global central bank peers have mirrored the dovish pivot that the Fed has done. So the Reserve Bank of Australia...
It looks like renminbi is hitting some new lows, recent lows now too, which I think, won't make President Trump very happy. But yeah, it's going to be hard to get the dollar much weaker.
Right, and on that point, Thursday, August 8th, we've got China imports and exports for July. That's going to be a politically sensitive looking number. It's probably not going to look great, but as you say, the weaker renminbi. If it's if we're trending in that direction, that's going to be another pain point for the White House. That's not going to be something that makes them particularly pleased.
Well, I think we'll have enough. We will find, whether it's things that we're planning for or surprises next week, I think we'll have enough to talk about. John Fagan, Matt McDonald, and to everyone, thanks for tuning in. Enjoy your weekend. We'll be back with you next Friday on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.